Tuesday, February 5th, Season 1, Episode 3. We're all back here again. Another interesting topic that is going to be some good information of some of the stuff that we actually just learned about this week. But let's start off with our introductions here.
Bill Seach.
Tom Christie.
Trey Reedy.
Adam Baumline.
So what we're going to get into today, there's three avenues with the mortgage industry here in regards to who owns your mortgage. You may make your payment to Bank X, Bank Y, yada yada, but at the end of the day, 9 times out of 10, it's going to be a Fannie Mae owned loan, Freddie Mac owned loan, or Ginnie Mae. You may or may not know the difference of those, but there's a lot of details that go into all those, so we're going to focus on one today, which is Ginnie Mae.
There are private investors out there, but in general, a vast majority of the loans.
Most people are looking for a mortgage.
So.
Unless you're a hard money lender, most people are looking for a house. It's going to be one of those avenues there. But again, today, Ginnie Mae, that's the government loans. So, and again, some very important information on this. It could make or break a deal for you. It could, if essentially, lose a deal right in the middle of it with some of these changes that have happened that we've just learned about. So. With that said, Adam, you want to kind of lead into what you've kind of discovered with this because you're the one that brought it to our attention here.
Yeah, so we saw a video online yesterday from actually one of the, I guess, people or groups that we follow that we get good information from. Ginnie Mae has essentially come out and said that so for non-bank lenders, so if it's not a BANK, a bank, in our world here in Central Iowa. A Chase, a PNC,
FDIC insured,
depository
FDIC
institution.
That they are going to start looking at those institutions to see if they have enough liquidity, if foreclosures start happening, if they can survive. So banks have to go through a stress test to make sure that they have enough money. If people essentially stop making their mortgage payments, that they will be able to survive. It's one of the changes post, the crash. So. I think it said in 2004, and I can't remember exactly, but roughly in 2004, only 20 to 30% of the loans that were loans through Ginnie Mae were actually coming from a non-bank lender. So a mortgage broker, a mortgage banker, a direct lender of that type. Now I believe it's over 65%.
Yeah, that's insane.
So it's a huge
big
increase in the number of loans that non-bank lenders are doing that are selling to Ginnie Mae. So, your government loans, your FHA loans, things like that. So they are getting more and more concerned that what if something happens, are those institutions going to be able to survive if people stop making their mortgage payments? So now they are instituting some sort of a stress test or something to these companies. So what does that mean to a buyer? How does that affect the mortgage market? What's going to potentially happen there? Well, if they come to a mortgage banker, a mortgage company around here, and they say, hey, we need to make sure we're going to put you through this test, make sure that you guys have enough liquidity or money in reserve that if something happens, you can survive. Things can remain status quo. If they don't, basically one of two things is going to happen. Number one, they're going to force them to increase their liquidity, which more than likely means they need to raise money, which how is a mortgage company going to raise money? They're going to increase their fees. They're going to increase their rates more than likely. Or number two, they're going to pull the ability for them to, in some case, originate an FHA loan.
What if the loan's in process right now?
Yeah, so if your loan's in process right now, and your mortgage direct lender says, hey, you know what, we cannot do your FHA loan anymore, you're going to have to move to either an entirely different loan product, which could change your down payment, or an entirely different lending institution, period. If you're in a 30-day purchase contract, that could create some issues for you, maybe just depending on when that happens. So, like we talked about, how does that affect us in the broker world? Okay, well, if we are going with lender X, and let's say worst case scenario, they can't originate the FHA loan. We're going to either know that ahead of time, or we can switch that loan over they make it so it's almost a seamless transaction because that there are documents
behind the scenes
and
where no one
everything,
even
kind
knows
of behind
really
the scenes,
happens.
and potentially, nobody may or may not know. The other piece to that is it doesn't affect the lenders that we typically work with are really at the top of the heap, if you will, right? They're the biggest, typically largest mortgage lenders in the country. So it's possible that one of them may not have liquidity, but we work with a variety of them, more than likely they would. So when you're working with, someone like us that's a mortgage broker, it's probably less likely that you would run into that potential problem.
Well, even if it did, to reiterate what you just said, is we have the ability to. Oh, so lender X has just had their FHA license revoked because they don't have enough liquidity to sustain any pullback or potential recession. Okay, well, we just go over to Bank Z over here. Well, they've still retained their FHA license, so we just transfer that appraisal, transfer the loan docs over to new lender that's going to close your loan and get the loan done. Back to Adam's point, what he was just reiterating there is even go back to season 1, episode 1. They were talking about the difference of retail banks and correspondents. If it can't go there and they turn you down, they don't have other options. So it's just a dead deal. Where we do have those options of saying, well, it can't work here, but it will work over here. So we are able to keep you moving along at a better pace.
Not every
with any kind
follows,
of unforeseen instance. You just don't know.
Yeah, they might have their own, as we talked about before, guidelines or overlays that are on top of the additional guidelines, and every lender is different, and certain lenders kind of operate in different spaces, and so that's where we have the advantage, and or we need to know who is doing what and who's operating in what capacity and what types of loans. So
exactly, and that's and again, all this stuff kind of starts to go back together again, like you just said, overlays, and again, those are things. Maybe one lender will go up to a higher debt ratio. Say, well, maybe your debt ratios are tighter with this lender, but we're fine with it. But this lender over here says, well, that lender might be fine, but we're not. Again, those are because they're trying to decrease their risk factors. And again, just to have a better portfolio of loans to withstand those stress tests. And again, that just all leads back to making sure that mortgage crash doesn't happen again. Just trying to be proactive with those things. And again, just know who you're working with. Again, just do your research on these people.
You got a deal you just saved from one of the builders, right, Adam?
Yep. We can do our kind of recent deals. I just closed it last night at 7:00 almost. The initial lender was not able to get some things done due to some guidelines that they had, and we were able to get the people into the home last night. She was on the plane at 5:00 this morning, leaving for work.
And just to clarify, they did a verbal verification process of the employment for us, so we didn't have to get some paperwork and things like that to make it happen.
Yeah,
so
we were able to get, through reduced documentation, we were able to get it done, and they were not, which made things a little bit nicer, a little bit more efficient.
Well, they had a home to move into,
really,
whereas the other one they had no loan with the other company.
Here, it was
they had a loan.
Yeah, turned down. So that's definitely something, and even that was a case to where we have certain lenders that do certain things or that are better at certain types of loans. Well, we chose the lender that was basically good for that, and we're able to get them in the home. So that was definitely an advantage that that we have.
Did you get an appraisal waiver on that?
That one I did not.
We transferred one though from one management company. Well, you
Yeah,
just signed up a guy to
I
make
got
it seamless.
Yeah, I got the appraiser signed up with the new.
Working smart, and it's being
management
creative.
company, yeah.
What you did in that instance would have been, well, hey, so borrower, you pay for an appraisal. This guy couldn't get your loan done. The easiest thing, and could have said, well, let's just go ahead and submit another appraisal order. But Adam took the time to figure out a way to ensure that this customer was not paying for another appraisal or excessive amount again, to lessen that cost, knowing appraisal was done already. And again, that's just taking the extra time because you're trying to get somebody in the best deal. It always leads right back to there's way more to this than here's a 30-year fixed rate mortgage.
You also got to give a big shout out to Elite Title because they got that done for you in 2 days.
Elite got it done, which was nice. They were kind of chosen late in the game with the builder rep guys. the builder title company couldn't come through, and they knew obviously the reputation of Elite, so that was great.
But wasn't that the builder's own title company that couldn't somehow collaborate together?
That was their title company.
And these builders also want you to use their financing companies typically and their title companies. Yet every time I've closed a builder's loan, there's typically an issue between that builder and their title company. Yet now they also try to get people to use their financing. It's just
not every one of them, but your bigger ones, yeah. But we also did this. We closed that other new build with an appraisal waiver.
Mm-hmm.
And that builder was phenomenal. And it wasn't their in-house title company, but it was a local title company in Powell, and we'd worked with them before, and they're great. On top of it, everything was worked with us, and that really was a seamless.
That was one last Thursday. Then that was
that was and she's relocating from Kentucky.
Yeah, and so that's 3 new build loans that we've closed in 2 weeks, and
not even
all 3 of them had weather-related escrow holdbacks, so the property was able to be occupied, but due to the weather, trees couldn't go in, landscaping, so they were able to hold that money back. So when weather breaks, okay, let's get your landscaping in. Didn't hold the loan up. Everybody still moved in their house. And again, there's those little things that you just don't have to mess around with, that we take care of and do behind the scenes that people just don't realize, to keep these things moving easily and simple for you. I have a loan closing today that I've taken somebody from 29 years left down to a 25-year fixed. All indications are talking about a recession, which if you're shopping for mortgages and rates, that's never really a bad thing, because that means lower rates. But that all said, the only thing I had to get this guy to close this loan was a copy of an email to show me that his loan was transferred. It was a different servicer.
Electronically verified.
Yeah. Yes. So we went and essentially took him from 29 years left to a loan, wiped out 4 years of his mortgage. He gets to skip 2 mortgage payments. He gets an escrow refund back. His payment went down $200 a month, and we wiped out 48 months of payments.
That's a huge one. Which we'll touch on this in another.
But that's always it just kind of just going into some of these things. That
the electronic verification we'll touch in, like exactly what's happening there, and what's going on. We'll do that in another podcast. But just so people can understand
simplicity,
what's going on. It's not an old school stated income loan or something like that. Everything's being verified. We're just using technology to get that information directly from employers and institutions.
But again, still, everybody has jobs, and I try to go back to the things that you did on that loan that could have been passed down to a client to, hey, when you get off of work, go and get this for me. Now you need to do this. We're taking on more of that work and getting things done. So there's less for you to do to get this thing done, and it's just quicker and easier. Do your job, we'll do ours, and let you know when it's ready to close.
Yeah. And I think the only thing that slows us down really is the appraisal process at this point. I mean,
that doesn't even slow me. That's a week for me.
Typically, if you got to get one, that's typically probably the longest piece. But now, like we were saying, I just had a purchase today. They're putting 20% down. I ran it through Fannie Mae and Freddie Mac. Freddie Mac offered them an appraisal waiver, so they don't even have to get an appraisal on the purchase of their home, which is nice. So that's the case. Number one, it saves them $480.
So legally, you're going to close that loan in 9 days.
Technically, I could. The minimum required time.
Right.
I don't know if the sellers can do that, but we'll be ready to go. We'll be ready early.
So I want to touch on something what you just said. So you ran the loan through the desktop findings. You ran through Fannie Mae and Freddie Mac, and we discussed this in the beginning. Then there's also the Ginnie Mae. That's government loans. That aside, so Fannie Mae was not giving you an appraisal waiver, but Freddie. So if this borrower had gone somewhere else and they only ran those findings through Fannie Mae, they'd be paying another $450 to $500 for an appraisal, not taking that time to run this thing through Freddie Mac to try to get an appraisal waiver.
Or if it was vice versa and Freddie didn't give, and they only did Freddie, and
so we're doing this both sides. Is there a way to get an appraisal waiver? We figure it out.
Well, that lender does both at the same time, right? So you don't have to pick and choose.
So with the one lender, it's just they call it one-click automated underwriting. So we click literally one button and it runs it through both at the same time. So we know immediately
which one can,
which is going to be the path of least resistance, and or which one can give an appraisal waiver.
Have you guys gotten any ones that are over 80% LTV for that? With less?
No, because it's got to be 80.
It's always got to be 80 for those. Okay.
So and along with the appraisal waiver, so now one of the lenders have come out with an additional step, or I guess additional option that we can have. they call it easy valuation.
And this is where things are going. Again, this is
Yeah.
talking about the wholesale side being technology first and really innovative when it comes to technology and simplifying the process for not only us but the consumers as well.
Smarter, not harder.
And this, and this is really big news here.
Yeah. So let's say we run it through both. We don't get an appraisal waiver. It says that we need to, get an appraisal. Now they still have to put 20% down on a purchase. You can actually get it on or rate term refinance. If you're taking cash out as refinance, it'd be limited to 70%. Then it has to be a primary residence. But assuming those are pretty,
you can
similar
call in and
guidelines.
we can give you more information about it.
Yeah,
But let's say what this thing actually is.
Assuming that's the case, and you don't get an appraisal waiver, what they can do is they have a $145 data collection fee where they'll go and collect data to see if they have enough to support not getting an appraisal. If that's not enough, then they only collect another $145, which is a total of $290, and then that's your appraisal. That's all that you need. So instead of paying $450, $500 for an appraisal, they're only paying $290, and it only takes between 2 and 4 days. So it's a much quicker process. Some appraisers you can get back in appraisals you can get back in 4 days, depending on what's going on, or if you wanted to pay for a rush or something. But so now it's basically simplifying that process for those buyers to make it even cheaper and even easier.
Yeah, and that's again, ultimate goal is that there's just working smart, and Trey, you just said that, work smart, not hard. And with the data and technology today, all this information is documented, recorded, and that's what's allowing some of these property inspection waivers to come back, because they've collected enough data to say we know values are in this area and supported. And in this case, now going forward, just now even further simplify the appraisal process, make it quicker, easier, cheaper for everybody to obtain what their ultimate goal is, which is buy the house or close on a refinance.
I think we've been pretty lucky too with the appraisers we have. I mean, they're pretty fast. I'm getting 7-day turnaround at a maximum right now.
Yeah.
It's pretty good.
Yeah, we've the appraisers on the panel for the management companies that we use.
I've been getting back in 7 calendar days. If I order it on a Monday,
good.
I get it back the following
Yeah.
Monday.
Yeah, I mean, obviously we talk to them, but
Now, the
you
client has to let them in the
consistently get
house too,
same-
right?
Yeah, well, yeah, but
Well,
we
that's-
seem to be
Listing
getting the
agent or
same
whatever.
appraisers pretty.
That's not always going to be the
Same
case, though, right? Because once the peak buying season, starts, they're going to be overloaded. And
Yeah, so I mean, once we get into summertime, typically they do slow down a little bit. So that's where this would come into play to make it nice. It's quicker. It's less work for the appraisers. They don't have to do as much because a lot of this data is being collected in the background anyways. It's us, again, utilizing technology to make things, like you said, smarter, not harder, easier, not harder, just allowing the process to be easier because, like Tom said, you have a life and you have work. You may have kids, animals, pets, whatever. You got a lot of stuff going on, friends. You don't need to go work a 40-hour-a-week job, then come home and spend 40 hours a week trying to get your loan. Let us guide you through that, make it easier for you, get a lot of this stuff up front. You close quicker and you're happier.
Yeah, and as we take on that work to get these loans done for everybody, it's we on top of that we're educating people, and I can say without doubt that every person I've closed knows more about this industry and how things work than the day that they had first called me, and that's something we all take pride in, is helping people understand the real estate market. And you're not buying a car, and I know I've probably said that on every episode here. This is going to be your largest investment, and that is exactly how we handle this. You're paying in a 401k or maybe other stocks on the side, but this is another side of your portfolio, and we're going to give you ideas on ways to move that asset around. Again, we just closing a deal today where we moved somebody down, knocked 4 years off their loan, and we're almost doubled the amount of money with the same payment they have going to principal now. So that's your asset. That's your money, and 10 years down the road, when that asset has way more capital gain in it, you find yourself being very thankful to have taken on some of these ideas and moving that asset around.
And if you don't know, please give us a call and ask. I mean, if your situation is where you have 24 years left on your loan, like you said, you can go to 20 or even 15 years now and have the same payment you have now.
We'll build our lenders will even do odd years or even years. So you can even go to a 22-year fixed. And most people think that you've probably never heard of that before. You're used to, what's a 30-year fixed, 25, 20. Well, we can do 27-year fixed rate loans, 23-year fixed. So if you're somebody that, hey, my payment is X, I got 27 years left, Well, maybe a 24-year fixed puts you with the exact same payment that you make now, but knocks off 3 years. And again, the math will tell you if it works or not, and we just want that chance to show you that math.
Yeah. Math does not lie.
Yeah, and you can look at it and you'll see, hey, you know what, this works. It either does or doesn't. You know, we won't waste your time and even send any information out. We'll tell you, hey, this doesn't work. You're already in a good position, but just to affirm that is, again, it's just to know that you're in the right position. That's because this is the biggest asset that you do have. It's probably larger than most people's 401k, especially for a first-time home buyer right now.
Yeah. Any other special stuff from you?
Well, what do you think in terms of? I mean, I know Tom mentioned that Brexit thing to me about Europe and stuff. What do you think projected going into the summer? What's the rates going to do? What do you guys think? I mean, you're around it every day. I'm around it every day. I think they've been hovering, and they have been hovering, but you know, people want to get scared. You know, the refi boom is going to come back. Everybody's saying in our industry, but is it coming back? Are the rates going to be there? We don't know, right?
Man.
And that's the question that everybody's been asking for years, because I can go back and I watch that treasury market religiously, and the stock markets is playing on our TVs in here, and we got Market Watch up on our computers. We've been hearing for years, rates are going up this year. They don't. Oh, no, this year. No, they're definitely going up this year. Nope, they don't.
Well, we saw a little spike in like November, right?
It started now.
Yeah.
But now we've started to see a little bit of pullback again.
Yeah, there's a lot of economic factors that would come into it. That's a tough call, man. I mean,
no one can tell you for sure.
It'd be
And
nice
if they
to see
do,
them around this level. You know, I mean, I think they made some changes.
So let's talk about the lock and shop thing. Okay, because that kind of, we're going to move into the busy season, right?
Yeah.
So how exactly does a lock and shop work?
Yeah. So you can have the option. You can lock in your rate for 60 days while you're looking for the price. So you have to find and close your home in 60 days, but you don't have to actually be in contract.
Do you have to have the address at least, or no?
You do not have to have an address.
It's called a TBD, a to be determined address.
Yeah. Okay.
Yeah. So if you find and close a home within 60 days, so let's say, you know, things turn around here and, you know, they get back on track and they start, you know, continue to raise rates and whatnot. Well, you're locked in for 60 days. So if rates continue to increase, then you're not going to pay the higher rate. You get the locked in rate.
And you can extend at that point, because I just did one where I had to extend it for 30. It only cost like 0.1 to the rate.
Well, rates got better, I think, in that case. Yeah. But if rates go down, then you can actually take the lower rate. If you haven't found a property yet, you can take the lower rate. Yeah.
And there's a renegotiation option, right?
So there's a couple of different things. Really, what it comes down to at the end of the day is it just allows us to have options to, if there's a change in the marketplace for the better or for the worse, that, you know, nobody can. We don't know what's going to happen. Nobody knows what's going to happen day to day. We have data and we follow feeds and
tendencies,
you know, MBS highway and things like that we follow, but. You know, that's not 100% guaranteed.
Nope.
You know, so you don't know for sure. Those are just some tools that we have to help protect the customer. You know, and or worst case scenario, if there's a huge fluctuation for some reason, we have different lenders that we can work with.
Exactly.
So we don't usually want to do that, but there are times where, you know, it's been warranted to do. So
sure.
And to further elaborate on that TBD, the lock and shop. You don't necessarily have to lock it either. If you're somebody that wants to float that market, you're more than welcome. Again, these are ideas that we'll share with you, and it'll give you something to think about. I find the most important thing about a TBD loan is if you don't have that property and you're in contract yet and you're just trying to shop, is your loan is essentially underwritten. So they're looking at your income. They'll look at your assets and say, well, borrower, you are fine. Find a house. Now all we have to do is show a contract, get the title work, get a homeowner's insurance and appraisal, and you can close your loan. Now, where that gives you an advantage, if there's multiple offers on a property, showing a listing agent that this borrower has already had their income signed off on, has been reviewed by an underwriter, you are most likely going to have a leg up on that scenario between multiple offers.
Man, that just happened to me twice. 2 houses in 1 week. The guy bidding, he's bidding right here in Dublin. And he gets to get outbid every time, you know.
But maybe if you had that TBD and said, "Hey, here's my loan approval. This guy has already been seen by an underwriter. His income is cleared off. Assets are cleared off. I just need a contract, and the house has to appraise, and you're done."
Right.
And to give somebody that peace of mind with so many variables that go into a loan, that's as close to a sure thing as you can have. Because I would be willing to bet anything 9 times out of 10 the pre-approval is just coming from somebody who says, yeah, we think it's going to be fine, but it's most likely not been in front of an underwriter yet.
It's probably just a
pre-approval that
pre-qualification.
somebody wrote up, and it's too easy, and I've seen it too many times where people will just do that just to throw something against the wall. And again, it's at your expense, and that's not where you should be ending up, because you will be led down a road of disappointment, and if somebody does that, it gives a black eye to the entire industry, and that's what we're trying to prevent, which is, again, why we lead you to ask questions, know who you're working with. If you're confused or you call us, whether we're working on your loan or not, we're here just to make sure you're getting the best advice possible to make sure that loan closes the right way for you.
There's really no stupid question.
There isn't.
You know what I mean?
There
Just
100% is not a stupid question out there. I mean, as long as we've discussed in our first episode, between this table, there's over 50 years sitting here, and we are still to this day learning. I mean, I ask Adam questions every day. I ask Bill questions every day. We're always trying to learn.
We're looking up I look up guidelines every day.
And
just
things
to make
change.
sure.
I mean,
So,
it's
So
we have to keep ourselves
Yeah,
ahead. That's
printing out
our
right
job.
here, so it's like, I mean, that's that.
It's something
There's
else
a lot of stuff there,
Yeah, and to have that TBD pre-approval and knowing that you've been underwritten, and we'll even talk to listing agents, and that's been a help to make sure somebody wins that offer. Bill made a great point. I mean, it can be very discouraging if you put an offer in and you lose that offer. Put an offer in and you do that 4 or 5 times, you start to lose faith, and I'm not ever going to find a house. Well,
Discouragement.
let's get your pre-approval and actually have a loan underwritten for your income and say, now let's see what happens.
Right.
Because again, I think a listing agent, knowing how these realtors are, and they want to see something done quickly and efficiently, to know that this guy is going to be able to close as long as that house appraises, let's go with them.
Right.
Yep.
I think I think the TBD is a big deal going into this year. Personally, I think it's going to be give people a much bigger leg up when it comes to these multiple offers. Because how many did you see last year? Multiple offers. I mean, it was felt like every loan. People were coming in overbidding, and like, this guy came in $5,000 over asking, $10,000 over asking.
I had 40 and 50.
Yeah, it's insane what some of these people do. Ultimately, what they're doing though is they're throwing it out there at a high cost, and let's see what happens to this appraisal. And if appraisal comes in short, then they're going to try to renegotiate. Again, things that just people shouldn't be doing, and it happens far too often.
Okay.
You got anything to add?
Well, I just want to point out a little thing about the investor things we got coming out now. I mean, as the subprime market kind of opens back up a little bit, I saw one 80% LTV, no doc on investment properties. That's pretty strong.
Yeah, it goes up debt service coverage.
And that's just saying, investing in real estate is good. Okay, so
it's very good.
You see a house that's $80,000 and you could put 20% down. That's $16,000. Now you got a rental property that you can rent out for $1,000 or $1,200 a month. People need to start thinking about that.
Sometimes it's better than a 401k.
Your money sitting in a 401k isn't going to make you as much money as that is.
Well, I ask everybody, if as far as rental properties, if you're at work and somebody asks you if they can pay into your 401k, would anybody here say no? So how's that any different than owning a rental property? If your mortgage payment is $500 a month and you can get rent in that property for $1,000 a month, somebody's giving you $500 a month just to live in your house.
Right.
And again, those are things that are people starting to beginning to open their. When you look and see that math for yourself, and that $500 snowballs, there's another asset that somebody is paying down for you. So when you turn around and sell it in 5 years, you walk away with tens of thousands of dollars that you did not have to pay into.
Right. Good thing for people that have money sitting around and they don't. It's a great investment. You can get in with very little documentation, no pay stubs, no W-2s, no tax returns, and you just buy that. You know what I mean? Yeah, the rate may be a little bit higher, but it doesn't matter because the rent debt service is going to cover it.
Exactly right.
So.
And there's multiple investment, avenues. Single family. There's, again, call us. That's why there's way more details to that.
The best one,
side, but it's something definitely look into.
The best ones I hear when my grandma passed away or was going to a nursing home. Now we got this house. What do we do with it? Well, they always want to sell it and try to cash out, but in actuality, would you rather pay you for 30 years or would you rather pay you right now?
Create another form of monthly income for yourself.
Right.
Whether if somebody wanted to keep that residual income, you can. That's make your mortgage payment, then dump the rest into your savings account.
Right.
If you so desire. You at least have more control of your money and your asset at that point.
True.
Awesome. I think that probably covers everything for this
S1E3.
week. We did want to let everybody know, try and follow us on Facebook, Twitter, Instagram, YouTube, LinkedIn, Pinterest. Twitter, Instagram, and Pinterest, it's Stratton C-Bus. Facebook and YouTube and LinkedIn, just Stratton Mortgage. So follow us.
Well,
We
of course, our
appreciate
website.
it. And the
Don't forget
website, strattonmortgage.com. Yep.
Yep.
Awesome.
All right.
Well, that about wraps up our episode 3 here. So we look forward to seeing everybody or talking with everybody again here next Tuesday. Everybody have a great week, and we'll be back here next week.
Thank you.
Thanks.